And so as you can see from the title, so this is about it. We talk about strategic financing and their crowd. And our motivation is a very long time and the very simple and easy question is how do you interpret the information carried by the internal or connected financing. So we know that there are many informal financing happen from family or friends or many other connected parties. But it's not, and it's a very common way, especially for the early stage entrepreneur to raise funds. But we don't know too much about what's exactly information and the outsider can infer from those type of activities. Of course, the first one is that it should be positive, because most of the time people can argue those connect person, family and friends, they have more information about entrepreneur or the project. So if they are willing to contribute money, that's a positive signal because they may have some superior private information. But there's the other side of the story, which says basically there are many reasons that the family and friends make contribution, and that can be a negative signal. For example, they may have different incentives. So they're not really looking for financial gain. They're just trying to support their friends, or they have very different incentive, or they just have a very they're just very costly for them. But there's RFS paper basically argue that if you have to use your family and friends money to do your business, basically you sacrifice the potential mutual insurance ability, because those money are basically as a cautious saving last resort. So in that case, it's not really clear if you observe more financing from those connected person, is this a good thing or bad thing for the information. So, but in general, even though the question has been there for a long time, but it's very hard to identify and try to get a clear answer. There's a couple of reasons. The first one is in many scenarios, those different types of investors contribute at different stage. For example, most time is that those informal investors are gonna move in the first round, and later those external investors are gonna start to make investment. But in that case, they essentially invest in the same project, but at a different stage. So in that case, it's hard to identify whether the external investor get information just because they observe the internal investor's behavior, or just get more information about the fundamental. Okay, and the second one is that many cases, those different types of investors may get different contract. They may basically invest by different securities. Someone might ask debt holders, someone as shareholders. But we know that if you have a different security, basically, if you observe more financing from informal or from family and friends, they may not only update your belief about the quality of the project, but also they may affect your payoff directly. So there's conflict of interest between different parties. And third one is in many scenarios, it's just very difficult to identify who are the people who has connection, who are the external investor. So in general, it's very hard to tackle this question. And in this particular paper, we try to study this information role of insider financing based on the Chinese crowdfunding data. Okay, so just in case you don't know too much of crowdfunding, let me spend a very few minutes just talk about what is crowdfunding. So crowdfunding essentially are online platforms that can allow the entrepreneur to raise funds from a large number of investors from the internet. Okay, and it started in early 2000, and now it has been quite a large market. Actually, the total size of the market in the United States is bigger than the total market of the angel investors. So it's growing very fast, and it's very popular right now. And if you are an entrepreneur, you try to start raise fund from the online platform, what you're going to do is, of course, first of all, you need to start a funding campaign. You need to provide some public information, which is information on the project, on your timeline, on your entrepreneur team, and so on. And then you need to decide a couple of things. First one, you decide what's your funding goal. Are you trying to raise, let's say, 100,000 US dollars? And the second one is the duration. So how long the funding campaign will be? Typically going to be a couple of weeks. Okay, so it's quite a short time. And then you need to make this like a menu. So basically, it depends on how much the investor contributed. They may get a corresponding promised reward or return. So depends on how much you contribute. You're gonna get a differentiate rewards. And one very important and preliminary feature in those platforms is that they have this called all or nothing rule. Basically, it's a threshold policy. So this is your funding goal, $100,000. So when the funding campaign ends, if you raise more than the funding goal, let's say $120,000, you get all the money and start your project. And of course, you have some promise to return to the investor. But somehow, unfortunately, didn't hit the target, let's say you only raised 95,000 instead of 100,000, then you have to return all the money to investors. So basically the funding campaign failed, okay? And as time goes by, the investor may randomly arrive on the platform and watch all the information, and they can make a decision whether to contribute or not, okay? And the question is why we try to answer this question using crowdfunding data. There's a couple of reasons. Of course, the most important reason is because we have the data, okay? And but in terms of those institutional detail, there's a couple of very nice features that can help us a lot in terms of disentangle the issue. The first one is that all the investor, no matter whether you are informed the family and friends or you are the external investor, you invest the same stage and the same project. You share the same public information and face the same fundamental, okay? And the second one, the campaign time is very short. So, and typically it's just a couple weeks, and typically entrepreneur won't really start the project unless they have a successful raise of fund. So in that case, it's very unlikely that investor can learn additional news about the fundamental during that time. So most of the time, what you really know is other people's action from the period, okay? And third one is that the price and the contribution level and the corresponding reward is predetermined. So when the start, they already determine if you contribute, let's say 500 US dollars, what type of product or what type of financial return you should get. So in that case, I'm sorry. So in that case, it doesn't matter. Essentially there's no price dynamic there. So it can, help us to save us from many complicated strategic interaction among investors. For example, you can manipulate people's belief at the beginning and then pump and dump. So we don't need to worry about that because the price is essentially fixed over time. And we have this all or nothing rule. This is threshold policy. So basically give you a very clear incentive to strategically manipulate the performance. Okay, so this is the same. And we use a very particularly Chinese crowdfunding platform, which is called Demo Hour. And there's a reason, because there are many, many crowdfunding platforms, and many of them actually share a lot of data with the researcher, but there is some particularly nice feature for us to decide to use this platform. The first one is that they have the full history about investments, and it's public. So if you're an investor, you arrive at the 10th day of this project, but it's public information that you can trace back all the last 10 days, which investor at what time and how much amount of money they actually make an investment. So basically you observe this whole investment history and it's public information, so everyone can get it. And this is not a unique feature for this platform, but the very few platforms actually have this feature. And the second one, I think what's more important is that this platform gives you an option to log in, use your social media platform. Okay, so for example, in this particular case, they allow you to use the Sina Weibo, which is basically a Chinese version of Twitter. So you can log in, essentially use your Twitter account, and your Twitter account will show up if you make a contribution there. And we can come back because we know your Chinese version of Twitter account, so we can go back and see your online connection. So that's one of the way we try to identify your family and friends. Okay, so this is to give you a picture, give you an idea what it looks like. So you can see the left part is basically some public information about the product, and and basically as you can see, this actually is success. This function campaign has ended, and they reach more than 700% of what they try to reach. So this is a pretty successful deal. And what's really interesting feature is the right-hand side. So you can see the whole history of the contribution history. So you can see what ID and what time and how much to contribute. Okay, so this is a very nice feature of this platform. And in order to understand the information rule, we have different types of potential hypotheses, and we try to identify them. And the one we find consistent with our finding is the first one, which is called strategic insider financing hypothesis. So basically family and friends, they are basically time their contribution in order to manipulate and in order to boost the funding performance of the entrepreneur. Okay, this is the hypothesis we support, but there's some other alternative hypothesis we try to rule out. The first one is first standard is an informal insider hypothesis. Basically, those family and friends, they have more information about the project. So if they are willing to make contribution, basically it's a good signal. It's a positive signal about the quality of the project. And the second one is a slightly different version of this insider financing hypothesis. Basically, still family and friends try to help, but there's no information content at all. They just try to help, and they are non-strategic. I mean, anyway, I'm just jumping and give money to my son. I don't care the quality. I don't really time the timing. I don't really think about carefully about what type of, how much money I should invest. So it's non-strategic behavior. And the last one is a no learning theory. So basically, because the platform we're using is reward-based, basically the return is not a financial. The return is basically products it produce. So in that case, there's one potential hypothesis that those product value is private value. So I don't care how much other people think about this project. I just like the product, I just want it. So I don't really learn anything from other people's action, but we'll try to rule out as well. So before we start to talk about the empirical evidence, let's start with some anecdotal facts. So there's an ongoing story talks about anecdotal facts, basically show you that there's some strategic manipulation there. So this is from Phobos, and they talk about the crowdfunding. This is a report that talk about crowdfunding, and actually has some crowdfunding tips for the entrepreneur. And one of the tips is that you need to build up your network. You need to persuade your supporters, your family and friends to start, and it has a way to kick the momentum. And in another, this Indiegogo, this is one of the famous crowdfunding platform in the US. Also, when they have talk about the tricks for the entrepreneur, they also talk about you should email your networks. You should ask them to help you to create the momentum. So those are anecdotal facts. But in order, I'm sorry, in order to establish the empirical result, so we have three types of results to show you. The first one is we compare what's the relationship between the early contribution from friends and the final outcome. And actually we figure out it's negative related. And we'll be more specific about what types of regression we're running. But if this is true, basically rule out informal insider problem, because if informal insider hypothesis is true, then you should observe a positive relation. But this one can now rule out whether this is a strategically manipulation or it's non-strategic. I'm just threw money in and that's it. So in order to distinguish between those two theories, we try to look at the time pattern of those friends' contribution, because we have all the contribution history there. So we can show you two different evidence because give you a sense that there at least some insiders are trying to time their contribution to help the investor, to help the entrepreneurs. And the last one is about the new learning, and also about try to complete the manipulation story. We try to basically say who are the ones hurt and who are the ones actually know and learn. So we try to identify two different types of groups of investors, and one is sophisticated, one is naive, and they're gonna behave very differently as we show you. Okay, so before that, let's look at the data. So the data is, this is not a very large platform, and you can still log in the website, there's still website there, but unfortunately it doesn't work anymore. They're no longer active anymore, but we have the early stage data, and it started from 2011, I think end in around 2014. And there's a lot of different industry, and you can see there's a lot of contribution, and there are a lot of founders. So we have a lot of dynamic, individual level of dynamic, but we don't have too many projects. We have roughly less than 900 projects. So sometimes we have some problem in terms of power because we don't have too many number of projects in terms of project level regression. And this is a summary statistic. As you can see, roughly speaking, half of them success. And the funding goal is roughly speaking 3,000 to 4,000 US dollars. It's not very large, but it's not very small. It's very consistent with the data from Kickstarter and many other US crowdfunding platform. And you can see the number of funders per project is roughly more than 100. So basically you have enough rich dynamic to explore. And the average contribution is roughly 250 RMB. This is 2011 to 2014. So this is not a super big money, but it is definitely not small money. So it's not people just play this for fun. The series puts some amount of money in there. Okay, and the average duration is roughly 6 weeks. So it's not a super long time. Okay. And in terms of social media, actually, we have a lot of people actually logging via the social media. Like among those roughly 800 entrepreneurs, there are roughly 669 entrepreneurs choose to log in. So they show their Weibo account. And roughly half of the founders actually choose to use the Xinlang Weibo to log in. Okay, and we can talk more later. And we have two different measures to measure the family and friends. The first one is, as you can already imagine, if we find that the founders and entrepreneurs who are mutually follow each other, then we basically identify them as family and friends. Okay, we do observe a lot of founders who actually follow the entrepreneur, but the entrepreneur doesn't follow the founder. So we think this most likely you look at the product, you think it's cool, so you just follow the founder. So we don't tell too much information from that side. And we do observe a small sample where, entrepreneur follow the founders, but the founder doesn't follow the entrepreneurs. And we take a look at their behavior. We have no idea what's going on. So it's a small around, it's roughly 100, 200 samples, but it's we cannot draw any conclusion from that. And of course, there's a bias, because for those people who choose not to log in as their Xinlang account, then we have no idea. We just identify them as external investors. So if you are an investor who try to manipulate the performance and you choose not to, if you think about it really strategically, you are more likely to choose not to log in, use your Xinlang account, because that gives you a chance to reveal your relationship with entrepreneur. Then you should actually more likely to choose not to log in. But in that case, actually will work against our hypothesis, okay, the strategic insider financing hypothesis, okay. And there is another concern, is that when we establish this relationship, it's exposed, because we observe someone make contribution, and then we go back to check their interaction, their online mutually follow interaction. So this is exposed. So there's a potential problem that the relationship may not be ex ante, it may be exposed. For example, I make a large contribution to a project because I like it, so I follow entrepreneur, and entrepreneur observes one large contributor there, and he logging in using the Xinlang Weibo. So basically, I follow him back. Okay, so this could be the case. So in order to address that concern, we manually connect the data from those on Xinlang account and try to check their interaction, whether they have some concrete interaction before the campaign. And the result is that most likely they have some interaction before the campaign. So most likely those connections are ex ante, not exposed. Okay, and I give you another evidence. It's like conditional your friends and compared to non-friends, you are much more likely to make an investment on the first day. And you're much more likely to make an investment in the first week. So this will also give you a sense that those friends are most likely connected person. Okay, so this is the first one we use to identify friends. And this is a very good indicator when we analyze the manipulation behavior. But there are another part when we try to analyze the investor reaction, the external investor reaction. So I observe some pattern of what's my reaction. It's not that reasonable to use this online friends interaction, because even though it's public data, but it's very hard to imagine like any random investor gonna trace back all the Xinlang Weibo data and try to figure out who are friends, who are not. I think it's just too costly, time consuming to do that. So we came up with another measure when we run regression about external investor reaction. So which is a first day large contribution ratio. So first one, this one is relatively easy to get because you have the whole history. So it's rather easy to figure out who are making a large contribution, who are not on the first day. And the second one is basically, this is very counterintuitive. If you're an external investor, this is the first day of this project, you are very unlikely to make a large contribution, jump in the first day. So if you try to make a large contribution, it's very natural for external investor to wait and see more information and then make a decision. So in that case, we use this when we run regression on the external investor reaction. And this is good in the sense that it captures some potentially large strategic investor who choose not to log in while Xinlang Weibo. But the bad thing is that it actually drops those small or medium contribution made by those friends who identify as Xinlang Weibo. Okay, so there are two contributors, and this is just some regression to show that those two things are highly correlated. So the friend, if you will use the Xinlang Weibo data and their contributions, are highly correlated. And you may argue that maybe friends are just different from other people, and we also run this friendship, and all the data basically show you that those people are basically contribute much more money, and they're more likely to be a large contribution. And even we contribute the same person, because you may say friends and non-friends are just two different type of people. We even found some investor who invested in multiple projects, and they are friend of the entrepreneur in one project, but not friend of the entrepreneur in other project. And we take a look, and you can see the contribution amount is quite different. So basically, if you're a friend, you really are more willing to make a large contribution. Okay. And now we also need to talk about the first day. Why we focus on first day? So the true answer is that if you focus on first few days, in general, it works, but it's just the statistical power gonna weaker and weaker. Because if you use the first week, then some project only has 1 week campaign. Some project maybe have a couple week campaign. So basically, you have the problem like whether it's early stage or not. So we use the first day. And the first day, this regression is just mechanical. It just gives you a correlation. It doesn't infer anything from this regression. Basically tell you that first day contribution, after you observe the first day performance, you can draw a very precise conclusion about what's the final funding outcome. So it's highly correlated, but there are many potential reasons. For example, if you have a first day large contribution, you're more likely to stay on the front page, so you have more visitor flow later on and so on. So there are many potential stories. And but here it's just a correlation. But we want to make sure that it's not mechanical. So suppose 90% of contribution were made by the first day. Of course, if you run this regression, you get a significant result. So we just show you that it's not a case. So there are many other things going on. So this is a case about the average mean or median about the first day contribution. So it's large. It takes roughly 10% to 15% of your total contribution, but still it's not 100% or 80%. So still there's a lot of things going on afterwards. So it's not a mechanical result. Okay, so now we can start our empirical results. So the first one is earning contribution from the friends. So here, because we are thinking about external investors' behavior, so we are using large contribution. So there are 3 different regression. One is on the performance ratio, so the total amount of money divided by the funding goal. Another is number of investors, and another is the binary indicator, whether your success passed the threshold or not. And they're all super negative. And it basically shows that there's negative relationship here. And we also run investor level. So this is investor level. So based on, so we can control the type of investor, because here you may say a large contribution ratio may relate to industry, may relate to many other characteristics, may relate to the success rate. But here we just control the individual investor. So even based on same individual, so those are based on individual investors who make more than 1 contribution. So we can control the individual fixed effect. So basically it's panel regression. And we also show you that no matter whether you use large contribution or friend ratio, which is identified by the Weibo data, it's negatively correlated. So this is a negative correlation, which rule out the informal insider trading hypothesis. Okay. And the next story is whether those people are, invest just non-strategic or strategic. I mean, our story is strategic, but there could be another reason, is that people just non-strategically invest. So both you and me are entrepreneurs. We have 5 friends to contribute on the first day. It's non-strategic and all. They just jump in and contribute, and that's it. But your project is high quality, so you get a lot of external investor interest in making investments. So mechanically, you can have a lower, large amount or friend ratio on the first day. But mechanically, I'm going to have high ratio, but it doesn't tell you anything. So the first one cannot rule out the non-strategic one. So the way we rule out to show you some patterns, which basically tell you that some investors are timing their investment. So the first one is about what happened in the first day night. So this is so basically we divide by the timing by 5 categories. Okay, so those projects start in the morning, and after the first day daytime, the entrepreneur may get a good sense about whether they are doing good or doing bad, and we take a look at what happened during the night. Okay, so this is the mean. This is number of contribution. And the second one is amount of contribution. As you can see, we compare the mediocre project and a good project depends on the final outcome. So there's a little bit tricky issue in terms of how to define the mediocre and the good. So we can address that problem in our second result. But here the mediocre basically says that, they're highly correlated with first day performance. The mediocre basically says that in the end of the day, it's like a marginal case. They could cross, they could not cross. So it's not unclear in the very beginning. And for those good projects, like the funding performance so good that basically from the first day performance, you're very confident that you will pass the threshold. So you are less likely to ask your friend to manipulate to boost your performance. But for the mediocre one, you are more likely to ask. And we do have the bad project result as well. but we have no statistical power because by definition, there are very few contributions. There are in total less than 10 contributions in the nighttime. And basically our interpretation is that you know your first day result was so bad that even you ask your friend to help, it won't help, so you just give up. Okay, so this is the first day. But the potential concern here is the definition, the boundary about a good project or mediocre project is a little bit backward because we use a final funding outcome, even though it's highly correlated with your first day of funding outcome, but still it's like a backward region. And so this is just the regression result. So in order to address that problem, we use a different scenario. So we use the end of the project, okay? So this is well-known effects. This is show up in our data, which is show you in the left figures. And the right figure is the same, but it's use the Kickstarter data. They have much smooth distribution because the number of projects is much larger. But basically what happens is that there is a lot of projects fail. And if they fail really badly. But there are very few projects that just not get it. So in 80% or 90% of funding goal, you can see very, very few projects there. But there are skyrocket, there's a jump in terms of project who just pass that threshold. So you can think this is definitely their manipulation or strategic behavior there who just push the project across that threshold. And what do we try to explore this? Okay, this is the mean. So we choose the timing 2 days before the deadline. So you have 2 days left. And we look at the beginning of the 2 days, last 2 days, what's your amount of money contribution so far? So for those funding has already enough to reach the threshold, basically you have no incentive to manipulate because you already passed the threshold, you'll get the money. So that's the blue line, which is called successful project. As you can see, the number of investors, and you can also take a look. This is the amount of money they contribute. They don't have any change at all. It's very smooth pattern. If you look at those almost successful projects, so still they haven't reached the threshold, but they're not far away from, then they have very strong incentive to ask their friends to come and contribute. So that's another way to show that their investor actually timing their investment, okay? So again, this is a regression. And the last one is try to talk about the investor, okay? And basically because if we try to complete this strategic financing story, we will explain why some but not all firms want to manipulate. Our story is that because not all the investors will be manipulated. There are some smart investors, sophisticated investors who actually observe this and they treat this as a bad signal. They think you are manipulated. And there are some naive investors actually going to be manipulated. So if you have a good project, you already reach a lot of support. You find it's very costly to manipulate because you're going to drive out those smart investors. But if you are mediocre or you are in danger and you know that sophisticated investor may not want your project anyway, so you will manipulate and try to ask those naive investors to jump in. So you do that based on the investor average funding performance. And we talk the top 20% and bottom 20% there, okay? And the results following. So basically the first one is the smart investor, top 20%. They are negatively correlated with a large contribution. But the bottom 20% is positively correlated with a large contribution on the first day. But this could be potentially mechanical. So we'll be very careful here because let's suppose investor just randomly assigned to a project. And we know from our first results, large contribution on the first day is negatively correlated with funding outcome performance. So if you are randomly assigned to a poorly funding outcome, poorly funding outcome project, you are more likely to face a higher large contribution on the first day. So it could be mechanical. So we need to show you that those two groups of investors are actually quite different. Okay, we can show you from many different perspectives. The first one is their investment behavior. Actually, you can see on average, the sophisticated investor invests much more money and they invest more project. And the second one is that the timing. So this is the average timing, distribution of average contribution timing for investor. As you can see, the blue line is a naive investor. They're much more dispersed. So this basically fits the story that people randomly arrive over time and make investment. But if you look at the smart investor, they're concentrated in roughly 2 weeks timeline. So basically spend some time to observe and learn and then start making investment, okay? And the next one is even more stronger result is that we show some persistence in terms of performance. So basically, we now rank the sophisticated and naive investor based on the first funding performance. And then we take a look at what's the subsequent funding performance. As you can see, the sophisticated investor continues to deliver higher performance in the subsequent investment performance. So basically, they have shown some consistency in terms of performance over time. And this is a distribution condition on your about your subsequent performance, condition your first performance persistent. Okay, so all the results show that the two groups are quite different. They're not just randomly assigned each time. Okay, so to summarize, so we showed that there indeed are many financing behavior on the crowdfunding from the family and friends, and it's actually strategic. Then the investor, the entrepreneur, basically use the friend financing as way to manipulate. And some sophisticated investors understand this and actually correct the market price, because we know that those people manipulated basically have a poor funding performance, but there are some naive investors actually hurt. Okay, so that's it.